So our next session is a panel. This is Africa's Century, an overview of Africa's economic emergence. The moderator is Mick Kabea. Mick is a vice president, senior analyst in the Financial Institutions Group with Moody's, based in London. He primarily covers financial institutions based across the African continent. And before joining Moody's, Mick worked in capital markets in BNP Paribas and in credit risk at Fullerton Financial Holdings.
Well, thank you very much for joining us for this panel, both in person and online. For this interesting discussion, I'll be joined by some senior investors in the African continent. First, we have Qatar Damani. She is Managing Director at Barings Asset Management. Qatar is part of the EM Sovereign Debt Team at Barings and member of the EM Corporate Investment Committee. Please, yes, please.
Thank you. Where should I sit? Okay. Good morning, everybody.
Morning, Qatar. We also have Peter Maila. He's investment director at CDC Group. So Peter supports CDC's equity, debt, and fund investment teams throughout the African continent. So thank you, Qatar and Peter for joining us. Let's maybe kick off with the title of this panel. This is Africa's Century, an overview of Africa's economic emergence. So several of the recent decades have been forecasted to be Africa's decades. And while progress has certainly been made, there remain significant structural challenges in the African continent. One can think about some of the fiscal challenges, the political risk, access to energy, as was mentioned earlier. In addition, the pandemic has weighed on economic growth last year, leading to contraction in real GDP growth for the African continent in 2020. And at Moody's, we expect that economic growth will be subdued over the coming years, given low vaccination rates on the continent, as well as limited ability for the government to stimulate their economies. So starting maybe with you, Qatar, do you expect the next decades, or maybe the next few years, if a decade is too long to forecast, do you expect the next few years to be marked by the economic emergence of the African continent?
Thank you, Mick. And thanks to all the attendees. So if you go for a coffee break, please come back. I think it's going to be an interesting discussion. On your question, I think Ms. Buss was just talking about it, actually. We would want Africa to be an emerging story for decades, have fast rates of growth across the continent in various economies. Unfortunately, the picture is more diversified than we might have hoped for. There are lots of divergence between different countries at different moments in time. And we have seen that, unfortunately, a lot of the countries are subject to different shocks and don't weather them well. And these shocks can be political shocks, geopolitical shocks, sanitary shocks, external shocks, commodity price shocks, et cetera, et cetera. So it's not a uniform picture that we have across the continent for all the countries. And I think that over time, what we need to build is more resilience, more institutional capacity, more fiscal space, and then more just a better enabling environment for the private sector, both domestically and externally, to invest in the potential. Because, as the previous speaker was mentioning earlier, it's true that the potential for the continent is amazing. It's huge, and in various countries, whatever their size, whatever their natural resources, whatever the population, whatever their level of development, the potential is there, except we have to build the enabling environment. And so therefore, forecasting for the next decade how it will be will depend on what the African countries will make of it. If countries are ready to embark on the right reforms, on building their fiscal space, on building the enabling environment, and building resilience to these shocks, then hopefully we'll see the emergence of this story that we have been waiting for decades. We have, since the 60s, basically, we are hearing, oh, the 60s, the wave of independence, everybody is so enthusiastic, and then the 70s, and then the 80s, and then we live through the commodity prices, and then the different political changes, and we just hope that this structural construction will carry on for the future in order to build this emergence.
Thanks, Qatar. And just to follow up on what you said before moving to Peter, could you maybe contrast some of the countries or some region within the African continent when you talk about this ability to weather those shocks?
Well, it's tough because I don't know where the people in the room are from, so I don't want to cause diplomatic problems or troubles. And it's also a difficult exercise because it would be effectively saying or giving good and bad points to students. And we know that the countries who haven't been able to progress as much as we had hoped have not done it for specific reasons. So exogenous shocks or specific domestic political situation and etc. But it's true that, for instance, if we were to give some themes, there are countries which are still subject to various political shocks over and over, and they can't seem to get out of it, unfortunately. Countries who have been subject to political transitions, and then it just takes them so long to get out of the aftermath of these political transitions. You have countries who are very dependent on commodities, who have tried to build more diversification from oil, from minerals, metals and mining, from agricultural commodities, and then it's not happening yet. For instance, you might have a country whose GDP is diversified, but then the fiscal revenues are all dependent on oil, and the external revenues are all dependent on oil. And even within the economy, the real activity, you might see that services are like 30% of the GDP, but then the services themselves are just very much dependent on the level of the oil prices and production in the country. And so these are some of the examples of themes. I'm happy to answer any questions if you want me to speak about a specific country, but it's true that, and it's not the same countries in all the periods. That's the problem. Actually, what's interesting is that there are a number of development economists who have worked on this issue of what enables the takeoff of countries. And in general, what they found is that it's not necessarily that you have fast growth rates. It's that you have consistency over time. So what is the problem for many of our African countries is that they have these booms and bust cycles, and they do not have a consistent stories. Danny Roderick, for instance, and his co-authors in the paper on growth acceleration show it. And they contrast with other countries like in the Asian region in the 70s and the 90s, where you see that what is important is just to achieve consistent levels of growth over a certain period of time. So what we are lacking is not so much 1, 2, 3, 4 years of high growth, is that we keep the rhythm of growth over a certain period of time. Unfortunately, because we are subject to these shocks and we don't have the resilience to these shocks, then we have the first year of bust, the second year of bust, and then to just recover from it takes a long time. So these are just some of the clarifications on your question.
Thanks, Qatar. Peter, do you agree with those views, and how do they shape your the investment case for the private sector?
Yeah. Good morning, everyone. I think the key point that you mentioned was, is this the century for Africa? The short answer is yes, and Africa has remained for centuries being the cog of the global trade. And you can read Scramble for Africa. But then in the next decade, what will you be looking for? And what is Africa will provide to the world that the world doesn't have? Historically, has been commodities. Unfortunately, some of those commodities are fossil fuel. They might not be relevant going forward. However, you look globally, whether it's in Americas or in Asia, in Europe, aging population. Africa is the only one with the youngest population, the future workforce, depending on who you ask, and how it's been described. And that is the future workforce to serve that aging population, the needs the world is still consuming on a daily basis. You look at the shortage of labor today, and those skills, Africa could be able to supply that. So that is the first part for me, I look at it. And secondly, why I still believe it is because of technology. Africa will leapfrog and will continue and has leapfrogged on technology. Today we're in banking and it look about everyone getting excited about fintech. And I say in Kenya, over 50% of Kenya's GDP is already being transacted through mobile payments. So you take a pause and say it's already happening in Kenya. If it hits Nigeria, what's going to happen? And by the way, it's already happening also in Zimbabwe in terms of mobile transactions. So Zimbabwe, you go with your Visa, Amex, MasterCard, you will be told, no, can you please pay with EcoCash? Okay. So it's already happening to that point. So that's where I am more hopeful, but you have to break it down. A century is long, so you might have to look at it in terms of decades in your investment models. So, and you can look at it the last 3 decades, the 90s, democracy emerging, we saw evolution of mobile telephony, the early 2000s, if you remember Nigeria, how many banks were in Nigeria, 90 plus, we saw consolidation, we saw the economic reforms cutting across most of the African countries. 2010, the last decade that we have been, we saw the highest FDI coming into Africa, and which had a positive impact, the emergence of private equity. When I started my career, I think there were 3 Pan-African private equities firms, and then by the 2010, there was so much. And beyond that, one of the things that we were tracking was the diaspora going back home to work, the skill set. And that what it also has done, interestingly, was the remittance. You look at the number of remittances in Africa, the transaction by volume, it's a lot. And you ask yourself, what is it doing in Africa? At CDC 2012, we invested in Export Trading Group. The number of smallholder farmers by then, they were in hundreds. We reinvested again early this year. The number of smallholder farmers just coming from Africa, it's over 10,000 to 20,000 smallholder farmers and producing in volumes. So you could see that there is a force, there is working, there is production in Africa already. So that's for me why I look at it. The hope is that the private capital of that remittance going back home in trade in Nigeria, you look at Dangote Cement, people are building homes, people are building factories. You look at the number of African entrepreneurs. 4 decades, 5 decades ago, there was 1 or 2 business people. All of them, they were state-owned. So that for me, I look at it in terms of the hope, in terms of for Africa. But again, it has to be, Africa is not one. You have to break it down, which country, which region, is it commodity heavy, is it agriculture, is it fossil fuel? What will it serve to the global trade?
Can I just make a comment on what Peter just said? So I just wanted to touch upon what you said about remittances and population, because effectively it shows, unfortunately or fortunately, I don't know how to take it, but that we have been efficient exporting people. This is what it means effectively. And so going forward, will we be able to do so in the future? I'm not sure, because the migration policies, especially in Europe or in the GCC or in the Americas, are getting much tighter. And so we know that going forward, we will be less and less able to do it. At the same time, we have the demographic pressure that you were mentioning. So we are really under pressure to create more jobs domestically. And the FDI coming in, I think, I don't know, I have to look at the numbers again, but I think it was more skewed to the first part of the last decade, in which you had a strong commodity boom. And then a few years afterwards, where it kind of rebounded after the bust of 2015 and 16. So I hope, I want to be hopeful, but I think that it's not as automatic as we might say. Technology will not just enable us to leapfrog. The reason that fintech was able to be so strong in Kenya is that you had a specific environment that probably you know much more about it than I do. And so I think what would be interesting for us is to see what conditions made fintech emerge or thrive in Kenya that it hasn't been able so far to do in another country, and et cetera. And then, for instance, just to track also the demographic transition across the countries to see where you are likely to have more pressure than others, where the people are likely to go, because you'll have pressure for people to go to other places, just to see how to handle this type of pressure that we are going to be faced with as a continent, because we are all exposed to these flows, and they might create, humanitarian situations or geopolitical situations. So I just wanted to add these points.
Thanks, Kata. You want to?
Yeah, and the greatest challenge is the young demographics. You could look at it as a positive, is a real asset if you're an investor. And on the other side, for the political leaders, it's a threat. You'll see the social unrest, you'll see the civil unrest, and because if they are unemployed and they have the knowledge, for me growing up, in South Africa, I didn't have a clue, I didn't have a friend outside of South Africa, I could not even communicate, write a letter or anything. They are aware of what's happening a youth is doing in South Korea. They are aware what the youth is doing. They can see on TikTok, and they're expecting the same level of service delivery. And that is the challenge in terms of if they are unemployed, if they don't have any purpose for it to do, we will see more civil unrest. Because they will be hungry and they will say, why I can't have it? Why is someone having that and I cannot have it? And those questions, you'll see them on social media, they're already asking, they're expecting the same treatment, equal rights, human rights. They're already expecting to say, I'm expecting to be treated as I'm LGBT, I'm a woman, I'm whatever race or gender, I'm expecting to be treated fairly. And that is the challenge, because if coming to the reforms, if people now, they said, I can set up a business in Kenya, transfer money, there are no red tapes, or in Rwanda, I can set up a business, open a company within so many days and able to transact. And someone in another country having the difficulty to do that, you will see the uproar.
Yeah. Well, on a somewhat related theme, let's maybe touch on the lasting impacts of the pandemic and how that potential scaring could affect the economic emergence of the continent over the next, say decade, because the century is probably too long. One area that comes to mind is the fiscal position of some of the countries, obviously, given the significant increase in debt issuances, in 2020 and 2021, in order to meet the needs of the pandemic. We may see some scaring, and when you compare the countries, you can see some countries who've managed to do some difficult structural reforms or somewhat reduce debt levels. And Angola comes to mind, Cote d'Ivoire maybe as well. Other countries are struggling maybe a bit more with the fiscal picture. Ghana comes to mind, for example. So, Kata, what are your expectations in terms of scaring, either from a fiscal point of view or any other point of view?
Yes, on the COVID impact per se, I hope its impact will not last for a century, because we can't afford it. We already have too many issues to start with. And in general, the generational impact that has been assessed so far, because it's quite early to assess already what the impact will be, is in general through the education channel. And we already have it's not a uniform picture across the continent, but we already have discrepancies among the educational performance of various countries. And so I don't think, hopefully, that this channel will materialize for African countries. It doesn't mean that we don't have to fix our educational problems to start with, but anyways. So just on the shock and how we might recover from it, I think it depends on the countries, because first, the shock on the GDP, on the real activity, usually materialized through the lockdowns. and not all the countries have had similar level of lockdowns in the previous years. In the previous 18 months, it feels like several years, but it's only 18 months so far. And it's true that some countries have had more stricter lockdowns than others. So hopefully this impact is just transitory. And for those countries, actually, some of the deterioration in the fiscal balances, you see it because you had a GDP drop. So the denominator was affected. And then, of course, you have the numerator impact, which is more expenditure and less revenues because corporates could not operate as usual. And then you had other types of countries which were affected indirectly because even though they didn't have strict lockdowns, but still they are dependent on the global economy turning normally. For instance, they're dependent on commodities. And even though they had very minimal level of lockdowns, their fiscal balances are dependent on revenues from XYZ commodity. And this will depend on how it's going to go going forward. If the prices are recovering, now they are recovering for some commodities, but also if production is recovering. For instance, we are seeing that in Nigeria's case, typically the oil prices are recovering, but the production is still very much affected. We don't know if it's only related to the OPEC constraints or if it's related to other considerations, but anyways, we need to recover from these production shocks. And it's true that, again, fiscally, it's true that a lot of the countries have received some support from abroad. So they have received support from bilateral and multilateral sources. They had the debt service suspension initiative. They also had inflows from the IMF and other multilaterals. The SDR allocation just happened like 2 months ago. And then a lot of the countries were also able to tap the private markets because there was a lot of liquidity because the central banks in all the developed countries were printing money and having a very accommodative monetary policy. So some of these flows were able to come back to these countries. A lot of the countries were not cut from the markets. They were able to issue 1 billion, 2 billion, up until recently. I mean, some of them even did ESG-related bonds. Benin did, Egypt did. So there was access to financing. And even domestically, the central banks were also accommodative in terms of monetary policy. So I don't see that the fiscal picture per itself related to the shock will be what will bring down some of these countries. Maybe some of these countries will have a crisis or an economic crisis or a debt restructuring at some point. But we are seeing even the countries which are talking about debt restructuring have had structural problems before COVID, that COVID catalyzed. For instance, in Zambia, the problems of Zambia in terms of debt are not related to COVID. They are related to something that happened over the past 6-7 years. It's the same with the Chadian debt restructuring. It's the same with the Ethiopian debt restructuring or participation to the debt service suspension initiative. So it's just to say that hopefully the fiscal picture is not what is going to bring it down. The external picture, by the way, neither, because what you saw is because the domestic demand was contracting so much, the import compressed a lot. And so they were effectively saving foreign currency. So, and with all these inflows from the bilateral and multilateral and the markets, they were able to accumulate reserves. So what we have to be careful about in terms of COVID impact is these chunks of the economies that are particularly affected, that are particularly exposed to some sectors. The commodities are one, the tourism are one for some countries like Tanzania, like Kenya, like Northern African countries who are particularly exposed to tourism. It was quite a hard hit. And oftentimes tourism sector is a big employer. So it's also an impact on employment, on domestic activity, and etc. So this is what we have to keep in mind. And we know that the resumption of these sectors is going to take some time. So hopefully the different governments are doing efforts to try to resume it, but it depends on the external demand, meaning people here in the UK, people elsewhere that are able to go back to these countries, or to rewire the economic activity to other types of sector to be able to resume.
So, Peter, do you agree that the fiscal position and the external position probably wouldn't feel that lasting impact from the pandemic, but some sectors like commodities and tourism may be affected. What's your view on that?
I mean, one of the external factors for me that I'll say, and I have no doubt most of the African central bankers will be kept awake by this, is the fear of another 2013 tapering. Because what we saw with the US when they started withdrawing the stimulus, the cost of debt in our markets just skyrocketed. And we're seeing now, because as Qatar mentioned, that in the developed world, there was a lot of stimulus put in, which fueled the developed markets' growth. Immediately that stops. What's happening? What are we seeing now? Inflation getting out of hand. Brazil increased their interest rates. So that for us in Africa, you can imagine these are the challenges. One, you're going to have the government borrowing costs skyrocketing, even with the debt service suspension initiative. It's still just 12 months. We'll see being rolled over. I think it was started December 2020 to be extended to 2021. I foresee another extension where I'm sitting. Secondly, and then now you look at the corporates or a borrower, that interest rate will be passed on. Thirdly is the inflation. People in developed markets, they are worried that they cannot get a paddle boat because they ordered it in April for summer and it could not be delivered because of supply constraints. The same people in Africa, they're not even ordering a paddle boat, they're just looking for food, okay? And they won't be able to get it because of supply chain. The cost of shipping, read all the time, it's skyrocketing. So that will have a massive impact on the ground, whether you are in business or you are in private. But on the positive side, you could look at it to say, what are the things now Africa could be able to produce or manufacture for themselves? So you could look at it as, like, these are the external shocks. Another way in terms of government borrowing, should they be going for hard currency or should they be borrowing local currency to avoid the FX risk? So it could be some of the options that they could be looking at it to say which sector. If you're there, the central bank, you speak with different ministries, said, let's open up this sector, let's reform this sector for local food manufacturing. That's A. Or, as you said, offshoring of jobs. Can we be able to do something here locally, given that there is shortage? And then the other one is in terms of local borrowing, because the fiscal, any central bank, especially in emerging markets, you cannot control the external factors. The US will decide, and they're doing it for their domestic market, and it will have an impact. And we have seen it. For many years, we studied the economic history of Africa or emerging markets get hit heavily. So can we be able to mitigate that with local borrowing, mobilizing domestic capital?
The only issue with local borrowing, if I may, is that local borrowing pool is often related to the current account deficits. Yeah. And we have large current account deficits. So by constraint, we can't have lots of domestic borrowing pools. And it means that the central bank would have then to print money. As you were mentioning, food prices, oftentimes in most of our countries, the food is a huge part of the CPI. Yeah. And so if we already have significant inflation that is due to external factors, if the central bank starts printing money that they don't have, then it means that the monetary factor or explanation for the inflation will add up to the food price effect to inflation, and then we'll have really high inflation. And then socially, we're very sensitive to that. Yeah. And of course, it will feed through the FX rates. Some of them are flexible, others are less flexible. Then you start having, so the domestic borrowing part of it is tricky. What the governments will have is either raise more revenues. Again, for instance, some of our countries have very low fiscal base. And so instead of borrowing more, they should just try to, it's difficult things to do, but they should try to increase their fiscal base. And at the same time, try to look for foreign borrowing if they can, because it's true that you're maybe worried about some of this FX mismatch on the country's balance sheet. But borrowing locally has a cost too, as long as we're not able to find FX receipts on the current account part of the balance of payments.
I think for me, and I agree with you, Kata, both sides, it's whether you hug a lion or you hug a shark. However, when you look at it, the elephant in the room, government revenues, tax collection, is at its lowest, whether it's domestic or whether it's foreign. So what could the government do to enhance tax collection or revenue collection? It's not more to tax more, but efficiency. What could they be able to do? Because there is a lot of what I'll call leakage on the cash management. And typically you'll hear most of the central banks to tap into another IMF, World Bank, because it comes with that structure of the dollar, because now it will be like, this will be in this account, you'll do a toll road, you'll issue an IPP, will be in this, governed this way. So the central banks, when you say do it that way, they know the reforms. They don't want to sign up to the conditions of the reforms because they know that trying to close this cash leakage. I think that if we don't address it really, say this is the cash leakage, because there's no point you borrow, but the money just flows into the hole. There's no point, whether it's domestic or foreign.
Yeah.
What is it going to be used for? And that's the issue, going back to, it reminds me of in the mid-90s, the highly indebted poor countries. At the time when the creditors were renegotiating with African governments, all the new governments said, that is not my problem, that was not my debt, it was not used properly. So if you were to look at it today, let's say where we are, 2021, there is another debt restructuring, whether it's domestic or local, if it's not used properly. 2025 or 24, a new government coming over will say, it is not my debt. It was not well managed. But the elephant in the room in most of the African countries is tax collection, cash leakage.
So just a quick follow-up, because I see the clock is running down. So a quick follow-up on the external subject, and then maybe we can talk a little bit about ESG. Kata, you've mentioned that the pandemic didn't have a significant impact on the external picture, given the reduction in imports and the multilateral funding and so forth. But as Peter was mentioning, taper is coming. The market is expecting it in November, probably until mid of next year. You'll have rate lift off at some point on the back end of 2022 or in 2023. What are, in your view, the countries, and maybe for Peter, some of the banking sectors that may be the most exposed to challenging to access dollar liquidity?
Yeah, I'd like to be in denial of the impact of the tapering, because I work at an asset manager. So basically we are a financial intermediary. We receive funds from pension funds and basically all these people who are benefiting from the direct liquidity printing in developed countries, and then we reinvest it in emerging markets. So we would also be affected by outflows, which means effectively that our clients will ask us the money back because they don't want to be exposed to emerging markets anymore. And then we have to figure out which countries to sell. So effectively, I wouldn't want to sell anything, but you're asking me which countries I would sell first, effectively. I think the problem will be probably the countries who are most exposed to refinancing needs, that are particularly exposed to the markets, that have received lots of portfolio inflows recently, often on the basis of high positive carry. And these countries, for instance, who are facing large refinancing needs, for instance, they have to repay Eurobonds next year, or they have short-dated paper, either locally or externally, especially if it's held by non-residents, so people like us who would buy, I don't know, Naira denominated debt or shilling denominated debt or other types of local paper, then we would need to exit the market because we are afraid of X risks in this country, or because our clients ask us to effectively give them back some of their assets. So I think that these will be the countries that are most exposed. And there are some of them in the continents. I mean, not all the countries are exposed to the external markets as much. Some have a thriving domestic market. Some countries have longer dated debt. Some countries have in their debt split are more exposed to concessional debt, so debt from multilaterals, and they have low cost of debt. Typically Senegal is one of them, Morocco is one of them, and they're not frequent issuers, and they don't have very large foreign holdings in their debt, either domestic or external. So these will be more shielded, I think. But the countries who are more exposed are the ones who have benefited the most from these inflows and have more debt to repay in the next 1-2 years, I think.
Thank you. Peter, any view, any country or banking sector?
I mean, in terms of, it's asking me which of my kids do I love the most or I hate the most.
Yes, effectively.
Yeah. In short, for me, I'll say make capital is like water, will flow to the least resistance path. And you can look at it, Zimbabwe used to be the breadbasket of Southern Africa, to the point that Zambia could not even farm anything because it was reliant on Zimbabwe. And Zimbabwe made some choices. Today, Zambia feeds Zimbabwe, because the farmers moved out of Zimbabwe, went to Zambia. And this is the example I said, the same area, it's not like suddenly Zambia's soil became fertile. It has been like that, but Zimbabwe made a choice, and we saw the Zimbabwean farmers moving to Zambia, and Zambia becoming the breadbasket. So similarly, that is capital. And so throughout for the central banks or the leaders within that is that from reforms and the choices that they make now will have consequences in terms of the investors. And the investors will invest in a specific country for that specific, if the reform is suitable for their capital at risk. So, it's similarly, look, the beginning of the decade, we had the Arab Spring, we saw capital flight out of North Africa. Today, Egypt, you look at it, I mean, capital is pumping back into Egypt or North Africa region. So it all depends, but you cannot say it's sustainable if you look back to say 10 years ago, what happened? And that investors will make a choice at that point with what the government decisions they are making, the reforms they are undertaking, their fiscal and their economic reforms. Investors will make that choice.
Just a quick word on ESG. I mean, we can all agree that it's difficult to look at a forecasted decade for Africa, let alone a century. But ESG will probably have very long-lasting impact on the continent and any other continent. Could you maybe touch on some of the key ESG issues that you see on the continent? Maybe starting with you, Qatar. What are the key ESG risks, and what are the key either regions or country that you see exposed to those risks?
So I must confess something. Originally, when I saw all this ESG coming a few years ago, being African myself, I'm like, oh, this is another concept that they want to force on us. Like these rich countries, they have all developed, they have all polluted, and suddenly we have to be environmentally responsible, and then we have to be socially responsible, and we have to have a great governance, and it's new financial imperialism. But that's my rebellious side maybe, and then I said, okay, I work on sovereigns. So it's a little bit different asset class because it all started in equities. And it's normal when you are the owner of a company, you can ask them to be more environmentally responsible, more socially responsible, to treat well their employees and etc. But for governments, also this a little bit bothered me because you started to have this type of attitude of investors in roadshow meetings or in meetings with government delegations, trying to pretend to tell what the government should be doing, which you have to be careful about, because as much as you have some legitimacy in maybe not giving advice, but at least conditioning some of your inflows by some ESG considerations or macroeconomic or structural reform considerations, you have to be quite careful about what you tell a government, because they have also, it's a sovereign entity, they have their political constraints, domestic constraints, all types of constraints. So this ESG I was a little bit cautious about in the beginning. And then I said, okay, let's think about the way that I believe in ESG, that I believe ESG is aligned with both the interests of investors and the interests of the stakeholders within the country. So I wrote a few papers. I encourage you all to read them. It's on Baring's Viewpoint website. But it is to say that for me, in the long term, if you have a country that improves the standards of living of its citizens, it's also in the interests of the investors, because it means that it grows, the standards of living are improving, the income levels are improving, and it's good for us because the country means that they have more capacity to repay. It's good for the corporate investors because it means that there are more things to invest in, and so everybody's interests is aligned. And so, long story short, I think that for us, investors, we have to make sure to insist on trend, not stock. This is very important because sometimes I meet some of my clients who are located in the Nordics and they tell me, oh, by the way, the starting position in terms of ESG in this country is very bad because there are issues of corruption, there is a lot of poverty, there are some environmental issues. I'm like, yeah, in that case, keep your money in Norway or Denmark. I mean, you don't, the objective, the letter and the spirit of ESG is that it helps countries improve. So basically you're incentivizing countries to improve on their ESG situation over time, and this is what your money is used for. And so this is why it's important to focus on the trend, whether a country is improving in terms of ESG or not. In terms of leapfrogging, for instance, maybe some of us, countries in Africa, can have a cleaner growth than other countries have experienced in the past because there are technologies that are more environmental friendly. You also have all these green bonds and SDG-related bonds that some countries have been issuing. Some have better frameworks than others. I know that Moody's, for instance, are, through Vigeo Eiris, is doing a lot of work, is very involved in this space. So you start having credible work that is done on these ESG-related bonds in order to make sure that that the bond that is labeled as ESG finances projects that are related to improving some type of ESG dimension in the country. And this is why, for me, it's a good opportunity for a lot of these sovereigns to be really structuring well their ESG frameworks, looking for the projects, looking for suitable infrastructure, quantifying the needs, and etc., in order to help us help them, help us invest in these opportunities, and ultimately, hopefully, have a positively trending ESG score.
Peter, we're out of time, but just a quick word maybe on ESG. Sorry about that.
No, for me, I think it could not happen soon enough. My greatest fear is climate change. Just imagine, or you were to think of what we have seen in the last, 24, 36 months, the cyclone, the field fires, if they were to hit, or drought, to hit one of the African countries or a region, we don't have the infrastructure to fight the field fires. Displacement of people, humanitarian crisis, that will overflow to a neighboring country. You ask yourself, we talk about borders being closed. That will have a major challenge for us in Africa. So that is why I say it could not happen enough in terms of the fast tracking of climate change initiatives. And, you know, at CDC, we will be deploying more capital towards the climate change. We're committing significant capital of our balance sheet. And I strongly believe it's for the right cause, because it is not anymore a China problem or developed markets or anywhere. It is our problem as citizens. Because when drought hits, we saw Cape Town running out of water. And water is the oxygen. And we will be run out. You look at the number of countries that are semi-desert in Africa already. We speak with the local farmers, smallholder farmers, they don't have water. Drought, rainy season is unpredictable. People are losing stock. So for me, that's why I strongly, it could not happen as soon as possible. That's for me, yeah.
Thank you, Peter. Thank you, Carter. Thank you so much.
So now,
I don't know if you have time.
Thank you, Mick. Thank you, Peter. Thank you, Qatar. Amazing. I could have listened to that for hours longer. Just such a great discussion. Thank you.